Today on Your Money, Your Wealth, we've got no time for a guest because Joe Anderson CFP and Big Al Clopine CPA are answering a whole slew of your emails, voice messages, and money questions. They're talking Social Security disability, filing and suspending, IRA contributions and Roth conversions, estimated tax, estate tax, gift tax, Social Security tax, the qualified business income deduction, selling appreciated stock, and whatever else we can jam in there. And some of the questions the fellas might even answer correctly. If you've got a money question or comment, go to yourmoneyyourwealth.com, scroll down the page to Ask Joe and Al on air, and send in your email or voice message, just like Kenneth did.
We got one, Al.
We did.
Good morning, Al and Joe. Question. I recently received a 2.5-year back pay check from Social Security Disability. The question is, will I have to pay taxes on this next year? And how would it be taxed? Will it be taxed on the yearly average pay? Or if it has to be taxed, how will it be taxed? And do I have to pay taxes on a back paycheck for Social Security Disability? And does receiving a pension, a CALPERS pension, affects my taxes for both state and federal on my Social Security Disability back paycheck? Thank you.
All right, Kenneth. So if I understand this, so he received a 2.5-year payback check. So he
How's
filed
that possible?
He filed for Social Security Disability.
Okay.
And so it went through the bureaucracy of
The what?
whatever. I knew that was going to come out bad. I knew it. Damn it.
Bureaucracy.
You know what I'm saying?
Yeah, bureaucracy.
Yes, thank you. Bureaucracy.
Bureaucracy.
Beer?
That's his new
You're still
podcast.
thinking,
There you go.
Still thinking about your birthday. Beer.
Yes, I am. It is my birthday, and I'm working very diligently.
I know you
Happy
are.
birthday, Joe.
Okay. So, right, it's probably going through the BS of Social Security for a
That's a
couple
much
of
better
years.
word for it.
Well, and that's
And then, they got to see if he's actually disabled, and they're like, oh, yeah, Kenneth, you are disabled. He's like, yeah, no doubt. I've been hung up in my bed. I can't
For 2.5 years.
For 2.5 years.
Right.
I'm starving here.
right, and that is a true statement because sometimes I haven't heard it 2.5 years long, but it can take a while to go through. And so what happens is they sort of backdate the benefits to when you were disabled, and you can get a lump sum. So I'll answer kind of the main question here, which is how is it taxed? And the answer is Social Security and Social Security Disability, it's taxed based upon your provisional income. And so if you have virtually no other income, it's generally not taxed. If you have other income, there's different levels to where it would be taxed, single versus married. The point, but let me get to the main heart of the question, which is if you receive a lump sum, it's the year that you receive it is the year you're taxed in. Unfortunately, they don't average it out over several years and do an income averaging or anything like that. It's the year received is the year it's fully taxable, even though maybe it should have been received over the last 2.5 years and maybe your taxes would have been lower, right? But that's the way they do it.
So Kenneth has a CalPERS pension. So he goes, hey, does receiving a CalPERS pension, affect my taxes? And the answer is yes. So you have income. So you have to add up, your provisional income, like Big Al just said, and that is your adjusted gross income. So you would add up dividends, interest, your CalPERS pension. If Ken's married, his spouse's income, and then they would take half of the Social Security benefits. But what I don't know, Al, on provisional income in a situation like this, they would not count that back pay they would count that as the whole amount of the adjusted gross. They would not take half of that. Would that be an accurate assumption?
They would not take half of that for provisional income?
Because let's say Kenneth's Social Security benefit is $20,000 annually.
Sure.
What's included in provisional income would be half of that, so $10,000
Yes.
plus his CalPERS pension, plus interest, dividends, and things like that.
Yeah.
And if it's more than, if he's married, $44,000, then 85% of the Social Security benefit is subject to income tax. 15% of it is tax-free. But that Social Security disability pension that is paid out to him, so would it go to the provisional income and let's say 85%, so 85% of that lump sum is going to be subject to tax?
I believe so, and the reason is because we're all cash basis taxpayers. So it doesn't really matter when we receive lump sums. It doesn't really matter what period it was for. It was the year received, and so what that means is that your provisional income will be higher because half of a much bigger number, right? And so then more of it would essentially be taxed potentially, depending upon how big the numbers are.
Right. So it could be tax-free.
Could be.
Yeah, it could be 100% tax-free, or 50% of it's going to be taxed, or 85% is going to be taxed.
Yeah, so yeah, there's these different levels, and it's not what we call cliff changes, which basically means it doesn't all of a sudden become 0 and then 50%. Once you get over into the 50% category, only that part is taxed at 50%. So it's kind of a gradual thing. But so the point is that it could be taxed at nothing, or it could be taxed as high as 85% of that income being taxed, whatever your tax rate is. Let's just say it's 12% or whatever the tax rate is. 12% of that income could be taxed, up to 85% of that income.
So I know that's just clear as mud, huh?
Yeah, pretty much.
I'm just trying to
listen.
And I'm thinking pension, weapon GPO, does that get involved at all? I don't know.
Not with this
not
situation.
Here.
Okay, good.
Yeah, the principal question is does he sort of get it spaced out over a few years? And the answer is no. The year that he receives the payment is the year it gets added to his tax return,
Right.
and therefore he's got to pay tax based upon that. And the fact that he's getting a bigger lump sum and he has other income probably means that more of it would be taxed than had he received it over the 2.5 years.
Right.
That's unfortunate, but that's the reality.
Yeah. The more I think about this, the more
We think we should call Mary Beth Franklin.
probably should call someone else to get this out.
Jeez.
But I think I'm 90% confident in that answer.
I'm 99.
99.
Oh, wow, okay.
All right.
I'll go
okay.
with that.
All right.
Yeah.
Well, Kenneth, if you get a giant tax bill, you know who to call. Big Al. He's standing behind his word.
Yeah.
I got 50-50 on that, bud.
I thought you were 90%. Now you're 50-50.
Well, 50-50 on
When
Al's
he
90.
mentions
Gotcha,
my
okay.
name, it goes way down.
All right.
What else do we got?
So thanks for everyone that's listening. See, that's a pretty cool thing to do. You just hit the button and then you talk, and then next thing you know, then you're on the air. I'm sure Kenneth is super excited. He got a little airplay.
right?
Got a little airplay.
That's right.
So yeah, go to yourmoneyyourwealth.com. You got to scroll all the way
All
down
the
to the
way.
bottom to where it says Ask Joe and Al on air.
Yeah, you
And-
got to get carpal tunnel almost on your wrist.
and
And
then
if you're on your
scrolling.
phone there, just hit the voice message button, and you can just talk into your phone, and we'll get it and we'll play it.
Yeah, and if you're on your computer, make sure you have a microphone
Yes.
on your computer. Otherwise, we won't hear it very well. Just FYI.
How many people do you think have done that?
A few.
Yeah, I left you a few voicemails. Well, how'd you leave me a voicemail? Through the computer. Do you have a microphone? Oh, that's why you haven't called me back. We got, let's see, Steve from YouTube land. I don't know where the hell that is.
I don't either.
I
That's
like
a
it,
new-
though.
it's a
I'd
new-
like to go.
New city.
You ever been to YouTube land?
No.
Oh, come on. We all spend hours on YouTube land. Anytime you go there and search for something, you're in YouTube land.
I've never really spent any time on YouTube.
Really?
That's because you got the Hulu and the Netflix and the Amazon and all that.
Not necessarily, no.
No.
YouTube was, you watch movies and stuff on YouTube?
You can. Yeah.
Yeah, I've actually watched some TV shows on YouTube, but for the most part, it's snippets. Yeah, it's like you have a
I could see you watching like how to learn how to speak Spanish or something
Oh,
like that on YouTube.
yeah, totally into it.
And that's exactly what it's
Well-
great for. If you want to know something,
Right.
Google it,
Learn
look
how
it
to
up on YouTube.
learn how to fix
Yeah.
a carburetor.
Or
Yeah.
if you want to know about Social Security.
I did
Yeah.
just do a how-to thing. I can't remember what it was,
Yeah.
but I learned how to do
It
it.
apparently stuck with you.
Not really. That's why I need YouTube. I don't even know what I YouTube.
Well, Steve was on YouTube and checking out some stuff, and he goes, after watching your info on YouTube, he had a question didn't see explained on the video. Well, Steve, we do that on purpose. So you come into our office and we sell you a bunch of stuff.
Not true.
All right. But since you emailed us, we'll give this to you for free. because we usually charge 5 cents per question. All right. I'm soon to be 69 years old, employed 24 hours per week with full benefits. He was a full-time employee up until February 2019. Is there a spousal benefit my wife can claim if I file for Social Security, then put a hold on Social Security till age 70? She's 66 years old. She can get 50% of my FRA, full retirement age benefit. Then once I reclaim my full 70-year benefit from Social Security, she will not get the benefit, and her own Social Security will build till she is 70 and starts collecting her own retirement benefit. Hope this is not too confusing. Thank you. Steve.
Social Security is confusing.
All right, let's break this thing down, Big Al. All right, first question he's asking us is that he is 69 years old and is curious about a spousal benefit. So the spousal benefit, let's just explain that.
Yes. So when you're the current law is that when your spouse is taking his or her benefit, and if you are retirement age, you can claim a spousal benefit. If you're full retirement age, that benefit is 50% of your spouse's full retirement age benefit.
So what happened is that Social Security was established, in the 30s?
Yes.
And most women didn't work in the 30s. No offense to any female out there.
No, that's the history. That's how it happened.
And so they were like, okay, well, we need to figure something out. So for years, men could not get a spousal benefit. So how it worked is that, let's say the woman stayed at home and took care of the kids. I'm not being sexist, but that's what happened.
Yes.
Okay? And so they gave that spouse a benefit. And that benefit is equal to half of the other spouse's benefit. So let's say my benefit was $2,000. My spouse had never worked a day in her life. She took care of never worked for money a day of her life. She worked her ass off at the house.
Well done.
Killing herself and being the best damn employee that the household could ever hire, right? Once she reached full retirement age, her benefit would be $1,000, half mine.
Right.
Okay? So what our friend Steve is asking us is saying, hey, can she get the spousal benefit? The answer is yes. But what he's asking us is that he would like to turn his on, and so she could claim it, then turn his off. That was called file for benefit and suspend. That is no longer, Steve. You cannot file for benefits and suspend. You would file your benefits at age 69. Your wife at 66 would claim a restricted application to take the spousal benefit. If the spousal benefit was higher than her own, because now there's something that's called deemed. You can't say, I'm filing a restricted application. I just want to take the spousal benefit, claim half of it, let mine continue to grow, and then turn mine on at age 70. These are old rules that went away in April of 2015?
2016.
2016, pretty close there. So what would happen is that once she's claiming for benefits, they are going to give her benefit or the spousal benefit, the higher of the two. She cannot let her, but 66, was she born before 1954?
If she's about to turn 60, she's 66 years old, so I think she was born in 53.
Yes.
All right, so she's born in 1953. She's still allowed to do a restricted application. So what that means is, Steve, yes, so she could file a restricted application with Social Security benefit, claim the spousal only, let hers continue to grow until age 70, then turn hers on at age 70. She could continue to claim the spousal benefit all the way till her age 70. So when you turn 70, hers just doesn't turn off. She would still have that benefit, that spousal benefit, until she turns 70, then it would flip to her own benefit.
Well said, and complicated. And so a couple things changed in April of 2016. You could no longer file and suspend and then have the spousal benefit be collected. And then the other thing was that deeming rule. That would take a whole nother segment or two, but it makes this much more complicated.
Since the answers to those last two questions were almost as confusing as Social Security itself, I've posted some Social Security resources in the podcast show notes at yourmoneyyourwealth.com, including our most recent interview with the goddess of Social Security, Mary Beth Franklin. Honestly, she explains spousal Social Security benefits really well. Plus, check out the Social Security Secrets episode of the Your Money, Your Wealth TV show and download our free Social Security handbook. It's all in the podcast show notes at yourmoneyyourwealth.com. And then after all that, if you still have a Social Security question that needs a complicated but correct answer, scroll down yourmoneyyourwealth.com and click Ask Joe and Al on air. Now, shifting gears from Social Security, let's answer those questions you've got about taxes, both estimated and otherwise.
Judy, she's a little San Diegan. The latest podcast talked about estimated payments to cover alternative year donations. Okay, I'm retired with pension. Not yet taking Social Security or using RMD. RMD stands for Required Minimum Distribution. I don't know how you use an RMD. Maybe you spend an RMD, but if you're not using it, do you think she's already taking it and not spending it, or she's not 70 and a half?
Don't know.
Okay. I do move some funds.
I assume she's not 70 and a half. We'll make that assumption.
Okay, but she's not using RMD.
Yeah.
All right. I do move some funds to Roth, taxes taken, and make charitable donations. Can you explain form WKRP? It's Cincinnati.
Remember that show?
Yes, I do.
Yeah,
I don't remember that form, though.
That was a great show.
Form W/4P.
That was Lonnie Anderson?
It was Lonnie
Yeah,
Anderson.
yeah.
That's we're related.
Yeah.
Yep.
That's what I thought.
I was
Cousin?
yes,
Distant?
distant. Yeah, I was under the impression that I could use this form at the end of the year if I needed to make additional tax payments without penalty. Second questions, are there state penalties too? If so, can you tell me about California? I think I learned a lot from you all. So what she's stating here is that with estimated taxes, and then we talked about this last week, I believe,
We did.
is that there's a timing sequence with estimated taxes. And you can kind of talk about it a little bit cleaner than me.
Yeah, this is interesting. It's like me trying to talk about what?
Let's just carry on.
I've got the W4P. And right in front of
Man,
me.
you are.
Look at this. I was prepared this
This
week.
is show prep, Joe.
Yes, I got it.
So, withholding certificate for pension and annuity payments. Yeah, so it's W4 is if you're an employee, W4P is if you're
pension.
withholding on your pension.
Got it.
Okay, so basically, all this is doing is it's telling the payor of your pension how much to withhold from your
So that's
pension.
like an I-9 or what are those called? Or
Well, it's a
W-
I think W9. That's if you are an independent contractor, I think.
whatever. But you know when you first get your job,
Yeah, that's W4.
W4. That's what I'm saying.
I already said that.
I know. Whatever. I thought
It
was
is called the
something-
W4P.
I said there's a
completely
W4 for if you're
I wasn't
employed.
listening.
I'm aware of that.
Judy, I'm sorry.
So, Judy, I'm going to try to answer your question now. The question, well, your question was, you were under the impression that you could use this form at the end of the year if you needed to make any additional tax payments. That's not correct, because this form is so you can withhold from your pension payment. Now, if you've got a gigantic pension payment of $8,000 a month and you want to withhold it all, then you would change this form for the month of December. But if you needed to make a payment larger than your pension payment, you could not do that.
She could change it throughout the year.
Sure.
But it's like, all right, well, instead of taking $300 out, you're going to take $400 out.
Yeah.
And if you owe $10,000 at the end of the year, I mean, it would be pretty hard to make that catch up.
Yeah, that's exactly right. So some people, I mean, I'm not saying this is right or wrong, good or bad. I'm just saying what some people do, and that is they have low withholding at the beginning of the year, so they have more use of the funds, and then they have higher withholding at the end of the year, so they basically catch up to the right spot. And then by year end, you've got the right amount of withholding. The IRS and state of California has no idea when that was withheld, and that actually is valid. Now, if you get to December, like I said, let's use a real example. You owe $5,000, but your pension payment's only $3,000. Well, you could change your W-4P if your employer or if the pension company allows you enough time to do it and have $3,000 withheld fully,
Right.
but you still short $2,000, you're going to have to make an estimated payment for that, and you will be penalized because you made it in December, not April, June, September, and then January.
So there's penalties if you under withheld.
Yeah.
And is there state penalties, California?
It's the same rule.
Same rule.
Same exact rule.
And that penalty is it's pretty small percentage.
It's small. It's about 3% annual interest, so it's not like it's the end of the world.
So if you owe $1,000, 3% on $1,000 is a couple of bucks.
Yeah, right.
James from San Diego. He goes, "Hi, Joe and Al." Come on, James. Love the show? Nothing like that? He's just right into the question. It's like, all right. If you sell appreciated stock in a taxable account at the end of the calendar year, it did not make quarterly estimated tax payments in April, June, and September of that year, is there a penalty for underpayment? Jeez, another penalty.
Right. No one wants to pay penalties.
No way. Can you pay the tax that is due to the government on the same day that you sell the stock to avoid any penalty? It seems that you might not know early in the calendar year what the future holds later in the year for tax purposes unless you're a psychic. James, love your little...
That's a great question.
I like that.
So we slam you for not liking the show, but we think your question's great.
Yeah, and I like his little comic humor at the end.
Yeah, so the question is relating to, so he sells an appreciated stock right at year end. So how could you make quarterly estimated payments when you didn't even know that was going to happen?
Or that you're even going to sell the stock.
Yeah, right. So I got good news for you, James. There's Form 2210, Underpayment of Estimated Taxes by Individuals, Estates, and Trust. You go to page 4, last page.
You writing this down, James?
Yeah,
Jesus.
please. Schedule AI for annualized income, part 1.
Oh, God.
Anyway, so the gist of this is the last page of this form. You get to put in your income each quarter, and obviously, if you sell that stock in the last quarter, then it just simply goes in that last quarter only. So you don't have to pay the tax the same day, but you do have to pay it by January 15th. That's when the fourth quarter estimated payment is due.
Oleg.
Oleg. That's kind of Oleg?
Oleg, he's Russian.
Oleg. From San Diego. Not Russia. It says San Diego here. Question 1. All right. When am I expected to pay projected taxes for next year quarterly? By the end of year? Any penalty if I pay them next year when taxes are due on April 15th? So, God, this is so popular. I mean, we talked about that once, and all we do is get questions on this stuff.
Yeah, they want clarification.
I don't want to pay that $4 penalty. So question 1, Alan, can you please answer that?
Certainly. So there are 2 ways to avoid penalties, and either you pay in up to 90% of this year's tax, right?
So if you owe
$10,000, as long as you pay in $9,000 quarterly, or you could do it withholding-wise. Withholding, the IRS doesn't know when it's withheld, so as long as you have $9,000 withheld, you're golden. If you don't have any withholding and you pay it quarterly, right? So what's that? Like $2,250, I guess, quarterly. You have to pay that each quarter, otherwise you get penalized. And so that's what he's referring to.
And isn't there a certain percentage? Isn't there kind of some weird? So.
Well, that's the first way to avoid the penalty. Maybe this will answer your question. The second way to avoid the penalty is to pay in 100% of last year's tax, regardless of what this year's tax is. So last year's tax was
$10,000,
$5,000.
Okay.
This year's $10,000.
Got it.
So as long as you pay in $5,000, then you're not penalized.
And is it a certain percentage on the quarterly estimates? Like I pay 20%, then 40%, then 30%? Then
for the IRS, it's 25%. It's one quarter each quarter.
25% straight
State
line.
of California is the oddball. They make you pay 30% the first quarter, 40% the second quarter. They let you skip the third quarter, and they make you pay 30% the fourth quarter. So try to figure that one out.
Okay, there you go. There had to have been something going on there.
So
where they needed a little bit extra cash.
one little caveat is if your income for the prior year was over $150,000 adjusted gross income, you have to pay 110% of last year's tax. So I'll just throw.
So
that
they
in
want
there.
you to overpay a little bit.
Yeah, in that example, they want you to pay $5,500 instead of $5,000.
All right. Question 2: is the first 20% profit not taxable by the new tax rules for the medical practice.
For a medical
I think he's talking about
the QBI?
Yeah, 199 Cap A, QBI, qualified business income deduction. So what he's referring to is a sole proprietorship, S corporation, LLC. Small businesses, flow through businesses to your return. You get to you don't have to pay taxes on 20% of the profits. Of course, there's all kinds of limitations, so it could be phased out, but that's the basic rule. And he's asking, do you get that right up front? And the answer is no. It's pro rata, which means that let's say your QBI deduction is $10,000, so you get $2,500 for first quarter, $2,500 second quarter, and so on. It's actually based upon your profitability. So whatever your profits were in the first quarter, you don't have to pay taxes on 20% of that, and so forth. So that's how they do it. And I think what he's asking, he's trying to skip the first quarter estimated payment because it's all tax-free up front. And the answer is no, you can't do it that way.
Interesting way to answer that question. Because I thought it was something completely different.
What do you think? What question do you have? Or how would you answer it?
Well, I think we answered it. But I thought the second question was completely different than the whole estimated payments.
Oh, well, if you have a different interpretation, then I'll answer that one.
Okay. So our buddy Oleg. God, am I so bad at this? How do I keep employed?
How are you on the radio, Joe?
I have no idea.
You have lots of personality and you're enthusiastic.
No clue. He goes, is the first 20% profit not taxable by the new tax law for his medical practice? So Oleg is Dr. Oleg, right?
Yes, Dr. Oleg.
And
with
he's
his medical practice.
healing people.
Yeah.
And he's got a business, and he's the man. And then so he's saying, all right, this QBI tax deduction, how the hell does this thing work?
Right.
I got profit, so is my first 20% of the profits that I make, is that tax-free?
That's how I took it.
That's how you took it?
Yeah.
Okay. So I'll answer that question.
Does the QBI apply to him?
The first 20%.
How does QBI work to this guy that has a medical, Dr. Oleg?
Well, okay. It's the first, all profits, it doesn't, first, second, third, fourth, fifth, sixth, however you want to break it up. 20% of that is tax-free, as long as you don't get disqualified for a number of other limitations and reasons. But
if his income
20%. But the reason why I thought he asked it on how I answered it was his first question was on estimated payments. I'm figuring he's thinking the first 20% is tax-free, so I don't need to include that in my first quarter estimate, and that's false.
I think because of the fact that he mentioned that it is a medical practice, he is asking if that is a service business that is under the QBI.
It is a service. It is a service business.
That's how I took it. That's why I took it that way.
But if we want to go down that path, then it gets way more complicated. Service businesses. If he's married and he and his wife make less than $320,000 approximately of taxable income, it doesn't matter whether it's a service business or not. He gets the full 20%.
If it's over that, then it's a totally different.
Then there's phase outs like crazy. So forget about it. And if he's single, it's half of that, right? So it's about $160 of taxable income. And so what I tell people, if you're married, less than $320,000 of taxable income, it doesn't matter if you're a service business or not. You get the 20%. As long as your business income is greater than your taxable income. Those are the limitations there.
Yeah. Because then you have these other businesses, and then you have another spouse that works, and then the taxable income is high. So it's complicated.
It's complicated.
So there you go, Dr.
So
Oleg.
maybe, Dr. Oleg, maybe.
Check the podcast show notes at yourmoneyyourwealth.com for more on the qualified business income deduction. Now, the fellas have a couple more of your money questions to attempt to answer momentarily. But if you haven't done so already, the two best ways to show your love for Your Money, Your Wealth are to share the podcast with everyone you know. That helps us spread this financial literacy, and also to make sure that you're subscribed to the podcast. Episodes will download automatically to your device, and you can listen whenever you want. In the coming weeks on YMYW, Oliver Rennick from TD Ameritrade Network talks about the effect the media has on the markets, and economist Dr. Chris Thornburg returns to YMYW to give us his thoughts on the Southern California real estate market and the state of the economy in general. Share and subscribe at yourmoneyyourwealth.com.
All right, we got Rob. He's from Santa Clarita. You like how I rolled the tongue on that one?
That's really, you've been in Southern California a while.
I have. I have a pension plan at work. I have an IRA with Schwab that was rolled over from a previous employer's 401k. I make too much to open a traditional tax-deferred IRA and too much to contribute to a Roth. The way that I understand is that I could still contribute $7,000 to an IRA on 56 and still get the benefits of not paying the taxes on the gains and dividends and allow those non-tax gains to grow exponentially. Is this correct? But would it be wiser to convert a portion of my IRA to a Roth or do both? I currently only have one IRA, so there is no complication with the pro rata rule if I convert a portion to a Roth. Of course, from your lessons, I would not convert so much that it would throw me into a higher tax bracket. Okay, Rob, let's talk about a couple of things. Lessons.
Lesson one.
Lesson one, you got to go back and reread and rewatch. Because you failed a couple of them.
Right?
You did say, you don't want to convert too much to throw you in a higher tax bracket. That is...
Yeah, we agree with that.
Check, A+ there. But, so he makes too much money. So is he single or is he married?
Well, we don't know.
Okay, well, I was going to say if you're married, then the Roth IRA income limitations is around $200,000.
Yeah, it's like 193 to 203 is the phase out.
193 to 203. So if you make more than 203 of adjusted gross income, modified adjusted gross income, Rob cannot put money into it. So he's doing a non-deductible IRA contribution is what he's doing, $7,000. So he's asking if he gets the benefits not to pay taxes on the gains and dividends and allow those non-tax gains to grow exponentially. I mean, like... infinity.
Because you don't have to pay taxes. They grow exponentially.
But if it's in a traditional IRA, Rob, you will still have to pull the money out at age 70 and a half, and then you will have to pay taxes on those exponentially gains that you earned at ordinary income rates.
Yeah, think about this. If you kept it in your non-retirement account and it grows, you're not going to pay capital gains until you sell that asset. You might have some dividends to pay along the way. But then when you do sell it, it's long-term capital gain, right? The way what you're thinking is you put it into your IRA, you defer the taxes, but all of that deferral, including the what most of the IRA that's in there,
you put $7,000 over the next 20 years, it grows to 50. Well, the $7,000 you put in comes out tax-free, but the $43,000 that it grew to is all going to be taxed at ordinary income rates if it's in the traditional IRA.
And it's pro rata, so that's $7,000. I don't know how much you rolled into the IRA, but let's just say it was a couple $100,000. Now you put 7 in, so now 7 divided by 207,000. That's the amount that's tax-free, and the rest is fully taxable. So there's some better ways to do this. Number one is either just not do it and leave it in your trust account,
your brokerage
non-retirement account to get long-term capital gains. Or if you have a 401k, you says you have a pension at work. If it's a 401k, you could potentially roll your IRA back into the 401k. The 401k will not let you roll in the pre-tax part, the IRA part, and so you'll be left with $7,000 in your IRA that you can convert and pay no tax whatsoever.
Yeah, but I think you just confused everyone else.
Probably.
Because what he's stating is that he put $7,000 into an IRA, all right? So do you get the benefits and the gains and dividends to non-tax for exponentially? Yes, until you have to pull the money out. So is this correct? Yes, until it's not. But would it be wiser to convert a portion of my IRA to a Roth or both? Well, it depends. He says he's only got one IRA. But if you only have one IRA, is that one IRA the only one with the $7,000 in? If that's the case, that's the only IRA you have, you put $7,000 in that IRA, you have no other IRAs, convert it. Because then it's now into a Roth, and then now that will grow exponentially tax-free.
In the Roth. But he's saying he's got the IRA. It doesn't matter if you have two IRAs.
He says, I currently only have the one IRA. Is the one IRA the one he just put $7,000 in, and that's the only balance of the $7,000? If that's the case, convert it. No pro rata rules. You're all good. If that $7,000 went into an existing IRA that had pre-tax dollars into it. Now he's messed up.
Yeah, but the second sentence, I'll reread. I have an IRA with Schwab that was rolled over from a previous employer's 401k.
Rob, you messed up.
That's why I answered that question that you said confused everybody.
It confused the hell out of me because I didn't read his full question.
So when you roll from your 401k to an IRA, now you got all this pre-tax money. You can't do the backdoor Roth anymore.
Yeah, you're done. You can't do it because it's all pro rata.
Unless you roll it back into
you roll it back into the 401k.
That's what I was trying to say.
Yeah, because what he says here, he's like, hey, there's no complications with the pro rata rule. Yes, there is, Rob. Yes, there is. We got Marcus. He's calling from Alabama.
Okay.
Good evening, Joe and Big Al. This is Marcus from Alabama. Roll Tide. Oh, boy.
Exclamation points.
Yeah,
In caps.
all caps.
Yeah, right.
Marcus.
Yeah.
Likes,
But big fan of the show.
big fan. He's a big fan of the show. Keep up the excellent work and providing funny but practical financial information to millions upon millions. Thank you, Marcus. I think it's two of you.
Well, even he says this might be an overstatement.
Little bit. I believe this was covered earlier this year, but can't recall the episode, so here's my request. Can you explain estate tax, gift tax, and current allowable gift exemption rules? There's confusion on how and when the gift tax and gift exemption rule applies. Let's say Marcus has got $5 million net worth. I'll give away $500,000 to an individual, non-spouse, which is clearly over the $15,000 limit. Do I have to pay a $485,000 gift tax, or is this subtracted from the current lifetime exemption of $11 million? In general, if one doesn't plan on having a net worth of $11 million, should there be concern as to the amount of money one gives away to an individual in a year or over their lifetime? Disclaimer: the above scenario is purely for educational purposes only. I do not have $5 million net worth yet. Thanks.
Coming.
Marcus, sounds like Marcus is in the business.
Yeah, he's planning on making some big money.
Yeah, he's a financial planner.
Right.
He's like, damn it, I got a client calling me.
How do I answer
How do
this?
I answer? Because this is a very sophisticated question Marcus
is.
has got
It
going
is.
on here.
Yeah.
So
and
ask these guys.
It's also
give wrong
very
answers.
specific.
Yeah, very specific. So Marcus is in the profession, and he gets a call from his client in Alabama. And he's like, son of a... I don't know the answer.
how do I answer
How do
this?
I do this? He's looking all over. He's on our website, and he's like, screw it. I'm just going to...
I couldn't find your episode.
Just gonna,
Just
I'm
say it
gonna,
again.
Yeah, just say, hey, I need some help.
Right.
Yeah,
It's good. It's a good question.
yeah, cool.
Yeah.
Well,
So I'll answer it.
all right.
So, Marcus, you are correct. It's a little over $11 million exemption right now. So what that means is if you were to pass away, the next generation can get $11 million of your assets with no estate tax.
No death tax.
No death tax, correct. And if you're married, husband and wife can each get $11 million. It's like $11.2 million, roughly. So call it $22 million that can go to the next generation tax-free. So if you think you're going to be over that $11 million, one of the things that you can do is you can start giving it away before you pass away. And so the IRS thought, well, we're going to have these rules because otherwise everyone could give everything away and then not have to pay any death tax on it or estate tax. And so they said, all right, so we'll let you give right now $15,000. We'll let you give $15,000, no questions asked, to anyone that you want to. But if you give more than that, you got to file a gift tax return because we don't want you getting out of paying this estate tax. Okay, so that's why these two things are related. So if you give away $500,000, then you file a Form 709, which I actually have right here. And I'm not going to go through it because it is way too complicated to go through on the air. But I'll give you the essence of it. A Form 709 is what you file each and every year. You give more than $15,000 to any one recipient. And so in your example, you give $500,000 away to somebody. So you subtract out the 15 because you're allowed to give that. So what's left is $485,000. That goes on the return. And in essence, it gets subtracted
From
from
the
the
11
$11 million. It's actually done in a different way. That what really happens is the $480, you compute the gift tax on that and subtracted from your unified credit. But no one understands that, including accountants. So I'm just going to say
It's the inverse of it.
It's the inverse. I'm just going to say that's roughly it, right? Basically, you're taking some of that $11 million exemption and you're giving it early.
Yeah, if you're taking like the CFP or CPA exam, it's the inverse. So you
Yeah.
actually need different numbers.
Right.
But for this show,
Yeah, for our ability
Yeah, I don't know.
to explain. Anyway, so I think that's probably the best way to explain it and think about it is you're basically giving some of your $11 million away early. And so why would you want to do that? Well, you would want to do that a couple reasons. One is if you felt like the $500,000 you were going to give away is going to grow in value, then when you give it away, it grows in the person you gave it to's assets, not yours, right? And the second reason you would do it is, you know what, this $11 million has only been just a couple of years. I mean, it was $5 million just a couple of years ago, and it could go back to $5 million. It could go back to $1 million at some point. So you give it away now while it's still an exemption. So those would be a couple reasons that you would do it. Or if you felt like Marcus and or his client was going to eventually make a lot of money, then yeah, you could start doing that right now.
All right. Hopefully that helps, Marcus. That's it for us today. For Big Al Clopine, I'm Joe Anderson. Thanks a lot for listening. We'll catch you next time on Your Money, Your Wealth.
Stick around to the very end of the episode for this week's Derails and check the podcast show notes at yourmoneyyourwealth.com to see the video of that last discussion on the estate tax and gift exemptions, and to read the transcript and to subscribe and share. All the links that you need are in the podcast show notes at yourmoneyyourwealth.com. Your Money, Your Wealth is presented by Pure Financial Advisors. For your free 2-meeting financial assessment with a certified financial planner, click the free assessment button at yourmoneyyourwealth.com. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
Did you have surgery or something? You got something on your chin? It's like, does it?
I do.
What is that? Is that?
I don't know, shaving accident?
No, it looks like a piece of hair that's blue. Oh, maybe it's just like from your shirt. It scared me.
Shadow?
No, you're good now. Okay. I thought it was
Better?
like stitches or something. I was like,
Yeah.
Did you fall down? And
Doing the show, I just go home and just fall over. I just can't stand it.
It was like you shattered your chin or something. I usually don't look underneath your chin, but because I'm a lot taller than you.
That's
What
true.
Yeah, I'm like 6'4". You're 5'1".
So you never get to see the
No,
chin
I never see
under the chin.
Yeah, I never see
Unless
under
you're
the
lying on the ground.
Yeah. Sorry, I'm lying on the ground right now because I threw my back out.
Wow.
I'm actually, to be perfectly honest, I'm 5'10".
Okay.
Yeah.
That's
just
why.
to-
That's why they
because
call you Big Al.
remember when you used to say I was 300 pounds? And then I would get mad, and then that would only make it worse. So I stopped refuting you, and then you stopped having fun with it, so you never did that anymore.
Oh boy, we're just having fun here at Your Money, Your Wealth. Isn't our buddy, the professor? Isn't he on the Santa Clarita, the behavioral finance guy? He talks in that accent.
Trying to think who that is. I forget.
This is what is called non-prepared with statements.
I do know Santa Clarita. I think that's where Six Flags is, Magic Mountain.
Herb? Is his name Herb? No, I don't know. Anyway. Okay, well, Rob, he's got a question. It's gonna come to me. He talks like
It's not Mir Statman, is it?
Mir Statman.
Oh,
Yes,
that
it is.
guy.
See, all I
Yeah.
have to do is talk like this.
Yes, and then it comes to you.
Comes to who?
Market efficiency. Market
You know, I met him.
Mir.
I met him at a Tiburon conference.
Yeah. Did you say what up, Mir?
Yeah, I said, hey, we had you on the show.
Did he go?
He said, well, it's nice to meet you.
Yes, he's very intelligent.
Yes.
And actually, we just hit 10,000 subscribers on our YouTube channel.
10,000
10,000. Wow.
subscribers to the YouTube
I remember
channel.
when it was 10.
Yeah, and it was you and I did it 7 times.
And your mom.
And then my mom. And then I think.
And I finally got my mom. That's how we cracked the
All
level.
right,
Wow.
So that was 9. And then, I don't know.
And then
But
it exploded from
10,000?
there. 10,038.
Is that a lot? I don't even know if that's a lot.
No.
That sounds like a
Not
lot.
really.
right? It seems somewhat like a
I mean, that's a lot of people that are paying attention to us. Yeah.
right.
And we're giving
But
good
then,
information.
some other guys like, what, my YouTube channel's got 10 million.
Yeah.
So
Yeah.
we're bragging
Yeah,
about
but they're doing like
10,000.
makeup tutorials and stuff, Joe.
Well, we could do that too.
We could.
We could.
You want to do that segment?
Well, Al, you wear makeup.